To the Reimagined Risk and Governance Forum here at Forvis Mazars. My name is Matt Dalton. I'm a partner here at the Forvis Mazars, and I lead our risk consulting team focusing on corporate accounts. So really excited to extend the invitation out to a broader community that we had in the past. We're now inviting heads of audit, heads of risk, audit committee chairs, and other risk professionals as we look to broaden the forum and cover really some new topics. Today's topic is really interesting. It's a risky growth and resilience, and I am really lucky to be joined by George Ligarius. George is our resident chief economist here at Forvis Mazars, and together we're going to explore the market, look at some of the economic outlook, and particularly pick up some of those recent events such as the autumn statement here in the UK, the US elections, and really talk through what's the impact of some of those events that we've seen globally. So George will provide some commentary. I'll then come back towards the end just to pick up and provide some thoughts and insights on what this really means for controls and assurance. We've taken lots of time for questions at the end, and I've been really lucky. Actually, a few people have sent questions through in advance. So we'll make sure we cover those off as well. So what I'll do is I'll ask you just to use the chat function on Zoom and just type in your questions, and George and I pick those up and we'll answer those towards the end. So once again, thank you for joining, and I'll pass across now to George.
Thank you very much, Matt. So let me start sharing my screen. Just indicate to me that if you're not seeing what I am, i.e. the slides. First of all, before we get into the forecast of things, let's just take a step back and see where we are. For 2024 and 2025, growth for the US and somewhat for the UK is improving. It is the European Union that is seeing the more lackluster growth. So according to the IMF, we will see 2.8% growth in the US this year and possibly 2.2 next year. And then in the UK, we'll see 1.1% growth this year and 1.5 in 2025. Now, how do we grow? Right? Because we really need to talk about this. And our demographics are not good. Okay, we're not having babies to the point that they would be helpful to growth. We have an aging population. The way this works is that you have a lot more workers at a later age being paid more and fewer workers at a younger age being paid less. So you lose out on productivity. How do you improve productivity? There are two ways. One is immigration, which is not very popular. And the other one is technological advances. So AI has yet to deliver. Personally, I've been running various experiments in my day job with AI, and I see that there is potential, but there are still many, many, many steps before all that stuff is useful to everyday activities. Case in point, I asked ChatGPT to summarize my weekly, which is 1,000 words usually, and I asked it to summarize to 100 words. Very simple input. The output was that of not even a grad, of a 17-year-old student. So there are ways to go before we can improve productivity. So how do we grow? We go through debt, and we have been doing so since the 80s. Okay, it's just a question of how much debt the markets can stand before they have had enough. A small caveat here: I am from Greece. I have lived through one debt crisis. I know the UK or the US, for that matter, will likely not see debt crisis, but that does not mean they will not see debt pressures. So we grow through debt, and we run large deficits. In the US, a deficit is around 6.5%. In the UK, it's around 4.2%. China is running big deficits, by the way, and so is, although they might not admit it, I think it's way bigger than the 4.5%. and Japan at the 5%. Really, that 3% threshold, you see the average of the Eurozone, but the average lies because there's France, and France will take until 2029 to get its own deficit back in order. In fact, 7 countries have been warned. So we're borrowing, and we're borrowing a lot more than we should. And in fact, if you look at the numbers, we're borrowing at an accelerated pace. Is this sustainable? No, absolutely not. If you look at the left-hand side, the dark blue line, the dark blue bar, is how much the U.S. is paying for, how much the U.S. is growing, 2% per annum. It's paying, that's the light blue bar, 4.5% per annum in interest payments. That's not sustainable, and the Fed has told us many times. France has a similar situation, growing by 1% and paying nearly 2% in interest payments. The UK grows by 1.3%, and its interest payments, even now that inflation is down, it's 1.6%. If inflation rebounds, the UK will have a much bigger problem because a lot of its debt is inflation linked. So the moment inflation goes up, interest payments on debt go up too. And of course, debt markets haven't been happy lately. And you see yields going up. More important, you see the UK and France, the UK around budget time and France around its change of government being pressured by bond markets because they want a resolution for the debt overhang. It is one thing for a new government to come out and say, okay, so we'll do a slightly more expansive budget. I hope you can all see my screen by the way. And it is quite a different thing to say, sorry, lost my track for a second. It's quite a different thing for markets to accept that. The government might say we're going to give more money to the NHS. Markets might wonder, okay, so where does that come from? And they can punish you with higher yield. So there reaches a point where you can borrow a lot more money, but because you're going to be paying so much more interest payments, that is not going to be the answer to your problem. Next slide, please. So the governments are now at the point where they're thinking about passing the back to banks. Those of you who are old enough and remember the 2008 financial crisis, the banks had a lot of debt on their balance sheet, and that came after 20 years of deregulation. So Mr. Reagan and Ms. Thatcher in the 80s, they had the growth problem, and the best way to deal with it was to literally raid the piggy bank. I let banks lend more because you create credit, you create growth, you create through debt, but that debt is not on the government balance sheet. After 2008, we shackled banks, and as it usually happens, government debt took off. Now we reach the point again where that is becoming less sustainable, or let's be honest about it, unsustainable. So take another one off if you can, Leona. There you go. No, go back. There we are. We are at a point where the government, we're at the point where government debt is very high and the debt from banks is very low. So we're going to reverse that, and we're going to deregulate banks. I know we're all focused on the budget, but the biggest thing out of the Labour government yet is Rachel Reeves speaking twice, saying that they think regulators can take on more risk. This is the US will do that too under the new Trump administration, and this will be the key driver of growth in the next few years. Okay, but in the words of a wise economic person that I know, now it's even riskier growth. So we're growing, but it's risky growth. Next slide, please. I think we've passed this, so we can go on to the next one. Now, economies are more liquid, and that means that essentially we have the basis on which we can on which we can build growth. So we have the liquidity around, and we're already creating credit. Again, we're going to do more, and we're going to do more on credit, which means that government balance sheets should a little bit deflate, and maybe some of those pressures abate in the next few years. But it's going to be riskier growth. So I want you to keep that in mind, especially when it comes to businesses. Markets are not stupid. They understand that this is a shell game. You pass the debt from banks to the government, and vice versa. And the question there is when and if debt markets will react. The answer to this is that markets don't want to commit seppuku. If they don't have a reason to react, then they won't. Okay, so economic growth, yes. Driven by debt, yes. Is it wise to deregulate banks now? Absolutely, because governments can't take anymore. Will this eventually lead to a crisis? Yes, around 2030, if you believe the financial literature. Next slide, please. Now, in this environment, the consumers are actually feeling a lot better, especially in Europe. One could see, of course, the US consumers feeling worse, but this one has a lot of, is very tightly linked to political outcomes. Around the election, in fact, we saw consumer sentiment falling, but if you asked consumers more detailed questions, you would see that this was split along the lines of their political behavior. So 5 weeks ago, a year ago, Democrats were feeling happy about the economy and Republicans were feeling very bad. Now, in a month's time, it has almost flipped. Republicans are feeling very good about economic prospects and Democrats are feeling very bad. In Europe, those indices are not so heavily politicized. In the US, they are. But overall, consumers in the EU are feeling better. And in the US, where they say they're not feeling so much better, they're still spending a lot of money. So I would argue that the consumer sector is, if not vibrant, it is chugging along very nicely. Next slide, please. Now, let's talk about inflation, okay? Because that's why we change governments. We don't like the price of things going up. There are two inflations. There's a goods inflation, that is your straight lines without the dots, and the goods inflation, that is your lines with the dots, and you have your services inflation, which is your straight lines. And as you can see, US, EU, and UK, you have very high services inflation and much lower goods inflation. Why is this happening? Because China is overproducing stuff. It's lowering prices so that people can buy it. So lower goods prices, higher services prices, but because that means that the overall headline inflation is still dropping, that allows central banks to take the foot off the pedal and reduce interest rates. So we are at a point in the cycle where we're seeing reduced interest rates, but the risk is that it is all underpinned by China. I will use the word because it is economically accepted, essentially dumping goods at very low prices to European markets, the UK included. So keep that in mind because obviously governments tend to react to those dumping practices and they're going to put up tariffs as well. It's not just Mr. Trump. And that can have an inflationary effect. Next slide, please. So our first key to growth is debt. The other one is China. We want China to grow at a pace where it can still deflate goods, but not at a pace where it's going to stoke inflation. And of course, it's its own country. They're not going to do what we want. Right now, China is slowing down, and they happen to be at the exact spot where we want them. but eventually the Chinese economy is going to pick up. So I think risks to inflation are on the upside, and so are risks to growth. On the other hand, if they don't, and if the real estate bubble proves too much to handle, you could see potentially a recession in China that's going to reverberate across the world, but that's not right now our main case scenario. Next slide, please. Now, as I said, and this is sort of what we said about inflation. The goods inflation is the dark blue line. The services inflation is the light blue line. And the circle is the average. As you can see, in terms of goods, we're way below average. In terms of services, we're way above average. And on the right-hand side, we have China doing us all a favor and making sure we have lower headline inflation to lower interest rates so that people can pay off their mortgages. Okay, but that is a situation that's not necessarily a long-term condition. I think that is the end of the slides. Now, in terms of further comments, obviously there are a lot of questions about Mr. Trump. The one thing I can say, because I keep getting asked this question, is that he has a vision that entails the overall of the US state. And that is a pretty bold vision. And he'll have to do it. He does have a lot of support from Congress and from the Supreme Court. But historically speaking, it's not somebody can order the change of the state and can happen. They would find a lot of opposition, and it is it's a magnum opus to achieve, especially in 2 years, because in 2 years, Congress could be different. So what does that mean for the economy? It means very high policy uncertainty. It means we do not know where interest rates are going to be. It means that a lot of the things around tariffs, especially, are inflationary. It means that they could have an impact around the world. And it means that if the tariffs are especially heavy, as he proclaims them to be, I don't think we're going to go there, but you never really know. The only similarity we can draw is with 1930, when the US imposed tariffs on the rest of the world, the so-called Smoot-Hawley tariffs. And by all accounts, they accentuated the Great Depression. So I don't think we'll get there, because for him to achieve his stated outcome, which is the overhaul of the US state, he needs a good economy to do it. Bad economies usually don't allow leaders to go ahead with their big plans. So I don't think we'll see very adverse economic decisions. We will see decisions that, when all is said and done, they will be more advantageous for the US than other parties. But as far as his economic and foreign policy picks are concerned, the policy direction is very clear. It will be deregulation. It will be America first in all the dealings, but at least there is no intention for chaos. Chaos could happen internally if there is too much opposition to some of the more exotic plans. As far as the budget is concerned, because we'll need to talk about that, the UK budget had a few items in it. Obviously, it had a lot more taxes, which will, all other things being equal, raise inflation. So a business tax will raise inflation, because the 70% of them are estimated to be passed on to the client, which means that the Bank of England is right to be careful with interest rates and not reducing too much if inflation stages a comeback. And also, they seem to want to do some fiscal expansion. In fact, a lot more than what was anticipated by markets, and spend a lot of that money on the NHS. But overall, they haven't been very specific as to how this helps growth. That is why they're going with the idea of deregulating banks further. That could give London back some of its edge if they do it way before the Europeans do it, and also if it stokes growth and the money goes in all the right places. Do I think that it was a good budget? I think it was a bold budget by a new government. And, personally, I like to see things changing. I like to see, initiative being taken. I like to see things going somewhere. It is my opinion, and this is a personal opinion, that if you do nothing, especially with the current debt levels, then you could find yourself within a stagflationary environment, very low growth, having to deal with inflation from all sides, global. And then what? So you need to take some initiatives. You can't just stand there and wait for the rest of the world to do something instead of you. And from that point of view, it was a satisfying budget. So we talked about Mr. Trump, and we talked about the budget, and we talked about the risky growth, and how do you deal with all this? If you're a corporation, you need to build up resilience. You need to understand that interest rates will fluctuate, and you need to understand that bond markets won't really like high debt. So if you need to roll over your debt, you need to be very careful about accumulating that debt in the first place. And if you need to roll it over, then you need to make provisions for even higher rates. So organizationally and operationally, because of all the issues with the supply chains around trade wars and what have you, companies need to build institutional resilience. They need to ask their boards, are we resilient enough? Can we withstand crisis? And then map out some of those crises and even run drills. I know some companies who do that. So this is where I will leave you. This is a world that's uncertain. With riskier growth comes more uncertainty. So being prepared for all outcomes, even at sacrificing some resources, builds up resilience. And with that, I think I can yield the floor to Matt.
Thanks, George. That's really, really helpful, really insightful. And we've got a few questions to cover off. But before we do that, just want to sort of summarize what I've heard and how our internal audit and risk and assurance functions can respond. If Leona puts a slide forward.
Just ignore the rest of the slides. Yeah.
There we go. Perfect. Thank you. Yeah, I just want to pick up a couple of things. I think George really covered the first one, the top left. I mean, there is radical uncertainty out there at the moment. And actually, that has wider consequences than just financial consequences. It actually impacts decision making across organizations and also people. So, how does your workforce feel? And really about how do we build confidence in the business strategy. A lot of the work that we've been doing more recently is actually looking at strategic programs and delivery of those programs and making sure the ambition is right for that organization. So they have the right people to be able to deliver that strategy. Point that to me is point number one is really important. Number two is AI, and AI is dramatically changing the landscape that we're seeing across our clients and our portfolios, whether that's using Copilot or ChatGPT. And it's creating much more efficiency. And actually, as a profession that is going to be changing what we do. I mean, there's still the human element at the moment, but building AI into your strategy is really key going forward. And for internal auditors and assurance providers, there's a role to play within that as well. Now in that macroeconomic situation, companies really need to differentiate how they grow. And if I put my consumer hat on, so retail hat, I think of how do we create emotional connection and how do we build loyalty with our customers. You may have heard the surprise and delight marketing. So how do we go above and beyond what customers expect? How do we create those memorable moments? And what I mean by that is you might have got a free gift when you got your shopping, or you may have got something in the post as a small free gift. If you get that free gift, you're 95% more positive about that company. And if you trust that brand, then you're most likely to buy from them again. So whilst there's so much competition for consumers' wallets at the moment, how those customers, also how those companies and retailers can differentiate themselves are going to be key to getting more market share. Creating more market share creates room for investment, creates room for growth. Third area is around the risk profiles. So we've sort of touched on that risk profiles are changing. We really need to make sure we've got risk functions that are agile and they also need to consider both the risk and the opportunity. I think sometimes we get so focused on risk and risk appetite. Actually, what's the opportunity in this environment as well? That opportunity may create a space for growth. On the bottom right is about internal audit as a seat of the boardroom, something that we at Forvis Mazars talk about a lot, and having a really dynamic internal audit plan. If you have a third line defense internal audit plan, you really need to focus on those emerging risks. We've touched on some of those today, things like working capital, supply chain. But I think one hot topic at the moment is every single company I talk to, every organization has a transformation program, whether that's an ERP system where you're moving from waterfall to an agile environment, where it's a major change. And internal audit assurance needs to have a role to provide assurance around those change initiatives that are happening. And the final thing, just want to lead you around assurance function is, we need to be curious. We need to continue to be curious. We need to continue to challenge the business. And actually, in this current environment, internal audit assurance and controls is actually even more important than it was many years ago. So with that, I'll ask George just to come back. So I've got a couple more sort of technical questions for you, George. George, thank you for that presentation. That's brilliant. That really kind of set it up. We've got probably about 10 more minutes, I think. So we've got a few questions here that we want to cover. A couple of them are in the detail, but if I kick off, first one was about wage increases in national insurance. So what effect on real wage increase will the changes in national insurance have?
A negative one. I think wages are on their way, are decelerating essentially.
Mm-hmm.
And the increases will probably be passed on to the consumer, which means higher, inflation in goods and services.
Mm-hmm.
So all in all, the real effect, if you get higher inflation and a slowdown in the wage growth, it should be an overall negative effect. Not by very much, but overall, if we had to put a plus or a minus, it's a minus.
Okay. Do you think any specific sectors, if we look at the UK, any specific sectors that's going to be having more of an impact on?
No, I think it's going to be broad-based. Look, if it's going to be on a company level, it has a lot to do with the structure and the cost of the company and how much comes from the labor force. So services are going to be more severely impacted than industrials, for example. Okay, industrials tend to tend to employ less people. They tend to rely more on machinery. So
Sure.
that should not impact them as much. But services-driven companies, those relying more on people, they should be more impacted.
Great, thank you. Another question just come in on the chat was, what are the effects of inflation, high or low, on mortgages?
Well, all other things being equal, higher inflation means higher interest rates. Higher interest rates mean higher mortgages, and vice versa. Having said that, there is a sweet spot, but it never really lasts for long, because if inflation is very high and interest rates haven't adapted yet, there are some cases when, for example, you might get a 10% inflation and have a mortgage at 5%. Take as much of it as you want because essentially you're paying less. But these things usually don't last. So all other things being equal, because central banks eventually react. But all other things being equal, higher inflation, higher mortgages, higher interest rates, higher mortgages.
Okay. Yeah, I mean, this takes me back to one of your slides earlier that I think is really important about how is this sustainable. You showed GDP growth and interest payments, GDP for UK, and actually interest was higher. Yeah. So when can we see it getting out of this cycle?
When we deregulate banks and we take the load off, we take the little ball and hide it under the shell that's called banks now. That's how this works. And I don't object to that. It's banks and government, and one of them holds the debt. The key is that nobody should hold it for very long. And the more you can do this, the more you can keep those balls up in the air, the less likely you are to have a problem. But the one thing that we need to understand is that not all countries are created equal. So bond vigilantes are out there. They will strike a country. I hope to God it's not Greece again, because I don't think I'll be able to take it once more. But they will hit a country, and that will send a warning shot across the bow to everyone else. Reduce your leverage, and the only way they can do that and keep people happy by continue to grow is the regulation of banks,
Yeah.
even at the expense of more risks and the future crisis.
Seems a bit of a scary place to be the next couple of years then.
Nothing is free.
Well, another question has come in around the spring and autumn budget. What do you anticipate the key changes we might see next year as a result of all this geopolitical activity that we've been talking about in the spring autumn budget? I mean, it's hard to ask an economist a magic ball, but what do you think?
Okay, so it is putting me a little bit on tough space. So what would I do responding in my budget were I Keir Starmer? Okay, first of all, beyond the budget, I would approach the Europeans. Okay, because if my left is hostile to me, not my political left, the left on the map, it is hostile to me, then I need to turn to my right, which is Europe.
Mhm.
And in that space, I would make sure we smooth out any differences left after Brexit, and that there's a close cooperation between the UK and Europe, which was always, an unresolved issue. I think that can reduce a lot of the trade frictions. In the budget, would I expect the UK to retaliate to hike tariffs against the US? No, I don't.
Mm. But the Eurozone's pushing the boundaries of growth as well, though, right? In terms of GDP versus interest, they're in a better
They're
position than
worse.
we are.
They're
Yeah.
worse. And take Germany out of the equation. That's the
Mm.
fiscally prudent. Everyone else, especially now, the non-pigs countries, they have problems. Interestingly, Spain, Italy, Portugal, Greece have all implemented very heavy reforms. So the markets are not too fussed about them, but they are really
Mm.
looking hard at France. France right now, in terms of the bond market, is the sick man of Europe.
Yeah.
Germany is the sick man of Europe in terms of the economy. But again, if I were Keir Starmer, I'd still maintain close relationships. I would not fire back against the US. And I would make sure that in this environment, there are ample provisions for those who cannot necessarily pick themselves up from the bootstraps.
Mm. Yeah, interesting. Really interesting insight. If you're a company, where would you be investing? Would you specific any particular countries you would? Because I think the UK is feeling a little bit less attractive now, and I just saw in the FT this morning, a company's delisted in the end of next month.
I would argue that the UK is more attractive. It has a
Mm.
better economy than Europe.
Mhm.
And here is a wild scenario. If the US turns more isolationist, which it seems to want to, that's not good for New York.
Mm.
Okay. New York is a global financial center. It needs to be able to hire the best people from around the world. It needs to manage money. It needs to do all that. And if the economy does not work out as they want, and if it becomes more isolationist, then no, we will just hire American and we will not get that bright guy from China or India to work in our New York office. Then they're going to set up offices elsewhere, the big banks and the big companies. And I think London is by far the most attractive destination. I know this is counter intuitive right now, but
Mm.
I think given where things are, the government, the UK government, is at a place where it can take advantage of it and um, help London recover a lot of what it's lost.
Is there anything that companies can do to prepare? Because there's a whole theme of this.
Reduce your leverage. In
Yeah.
1929 or 30, I'd say it's 29, Charles Merrill famously sent a letter to the press, and he told his investors, but sent it to the press, so it was an open letter. Now is the time to get out of debt. So quoting Charles Merrill from Merrill Lynch, um, I would say, I would echo that, and I would say, don't be leveraged now. Things could get weird in bond markets. And for those, the CFOs out there, credit spreads, the spread of what a company pays versus the government, are very tight right now. They're tight by historical um, measures. They're as tight as they have been in 1998. In fact, a lot of things are reminiscent of 1998, but that's a bigger discussion. So I would say that they won't get any tighter. Now is not the time to accumulate more debt. Now is the time to get out of debt. And that's how you build resilience. You make sure your supply chains are doubled up and tripled up and thin down as much as you can. If you relied on 10 companies, 10 countries to get your product, now you need to rely on 3 if you can help it. And if you could do it all internally, that's still good. You might pay a little bit more, but it's manageable from a global trade war perspective. Um, and they should need to build this resilience because in the past 20 years, consumers have become spoiled in getting what they want on the same day that they order it.
Mm-hmm.
In a world of broken supply chains, that will not happen.
Yeah.
So resilience needs to be both financial and operational.
Brilliant. Thank you, George. That's really helpful. I was about to close it, but two late questions have just literally come in. One for you, one for me. So your one for you, George, is the budget cuts and US shifts are going to ripple through the markets. How do we think this will hit everyday folks?
And can we repeat that? I'm not sure I got it. Sorry.
The
The
budget
budget cuts.
cuts and US shifts are going to ripple through markets. How do we think this will hit everyday folks? So I think it's more of a general question. Everyday people on the street.
Look, everyday people on the street. Okay, let me turn my socialist antennas on right now. Everyday people on the street want economic growth,
Hmm.
and everyday people on the street, don't particularly like to be pressured. And that growth, which has been a very, very below trend in the past 20 years, it will continue to be below trend. The everyday people. And being an everyday person myself, I work for a salary.
Hmm.
The way to go about it is to make sure, personally speaking, you do your financial planning.
Hmm.
You have some exposure in global markets because that is usually what can offset some of the low growth in wages, higher inflation, and all that.
Okay.
Okay, so actually, a small investment portfolio, which is what most Americans do, and what a lot of our bigger clients do, in fact, we advise them on this, is the best way to avoid pain if you are the folks out there.
Great. Thanks, George. The last question for me actually is around the UK. I think it's the UK Corporate Governance Code and what changes we may see around that. So just for everybody on the call, the UK Corporate Governance Code impacts all of those premium listed companies listed in the UK. And also I think we'll start to see that sort of ripple out into the QCA code and probably the weights principles as well. But it's very much watered down from what was initially proposed a couple of years ago. We're doing a lot of work with our clients at the moment around this, around how you identify your material controls. It's very different to the US legislation where you're looking at transactional financial controls and IT controls. What I think is good about the UK Corporate Governance Code, it looks at all of your principal risks. It's things the board should really be doing already. And so really it extends that to look at testing of those material controls and for board directors to sign off and give a declaration. The FCA is quite clear that it's about the FCA about its comply and explain approach. It's very much principles based. That's always what we've had here in the UK. So if you don't comply with things, you need to explain why and to give better visibility to investors of all of your principal risks, not just financial risk, cybersecurity, sustainability, supply chain, all of these elements. So I think this is a positive thing, I think, in the UK. The clients who we're working with are coming up with a much smaller number of material controls as opposed to what you do within the US. So I think we still see that's going to continue. I don't think it's overly burdensome regulation here in the UK. And I think it's a good thing for risk professionals, enables us to really be challenging the boards, challenging senior stakeholders on really what matters to the business. So I think that's really, really important. So I think we're at time. I'd just like to thank everybody for joining, and you've had a good turnout today, which has been brilliant. And as I say, we're going to keep these forums going next year. We're going to do a dual format. We're going to have the sort of webinar focus, and then over the summer, we're going to get more get together, some drinks, and some more networking session as well. We've got quite a few different topics coming up next year: cybersecurity, supply chain, operational resilience, which we kind of touched on a little bit today. But as always, we'd love to hear feedback from people on the call. Drop me a note on LinkedIn, or drop me an email to Leona, any topics, or talk to your contacts here at Forvis Mazars. So we'd love to hear from you, and making sure these things are really hitting the mark of what you guys want to hear about. So with that, I'd just like to wish you a fantastic festive season. I know Christmas is less than a month away. I hope you got your trees up, and good luck over the holiday season. And thank you very much for joining.